We have to stop talking about Bonanza. All right, that happened on this group.
Everybody knows the
You know it, Mike Jenkins, don't you? You sing it at home.
You're
every
making
once
me
in a
feel
while.
old because I watched it while it was on first run.
Bankruptcy attorney Mike Jenkins is joining us this morning. All right, folks, the kids are back at school, and it's time for us to pick up a pencil and some paper as well, because we're continuing to talk about a means test to see if you qualify for certain issues when it comes to bankruptcy.
Yeah, in summary, we've gone over the last couple segments how you qualify for Chapter 7 bankruptcy. We talked about how you first have to determine whether you're above or below the median income and how you get there. And if you're above the median income, then this means test kicks in, and we have to net out your 6 months of income, taxes and insurances come off, and then we start subtracting from that certain standards of living that have been incorporated into the law to determine whether you can have a Chapter 7 bankruptcy filing. And so last segment we talked about how housing expenses come off, and that was basically utilities, and then the greater of either a rental allowance if you're a renter, or your mortgage payments, and that's dependent upon what county you're in on the rental allowance.
And that changes or is released a couple times a year, correct?
A couple times a year to make modifications to it up or down.
Okay.
And so now there was a big category that we need to get to that covers a deduction that is given to families for food, clothes, and what they call other things, or incidental.
Other things.
As a business owner, that incidental tab can be wide-ranging.
and something to keep in mind. So what all falls under this category?
Well, it's pretty much your grocery bill and clothing, and I pretty much figure they encompass entertainment, but they don't expect you to be entertaining yourself too much if you want to have a bankruptcy.
Yeah, I didn't say if you're filing for bankruptcy,
and,
right.
just odds and ends things that aren't covered by the other deductions. So it's just this lot of money they give you or expect you to have, and some may consider it reasonable, and others may think it's awful. But again, it's gauged by family size. So a single person for this category gets $570 to deduct off of that formula. And to remind everybody that wasn't here for previous segments, Jack, you would first you deduct all these things off of the means test, off of your net, and at the end of the day, if you have less than $214 left from your net monthly income, you get to qualify for Chapter 7 bankruptcy. So
that's the number we're trying to get to, or to see if you do qualify.
Yeah. Hopefully you don't get there, right? I mean,
well, I guess it depends if you
No,
want
hopefully you do.
Yeah.
If you're seeing me, you want to have a Chapter 7 bankruptcy.
Okay.
And so this test is you have to have less than $214 left in this formula if you want to get that.
Okay.
And this is generally considered to be higher income earners, at least as the laws defined it. So the family of two gets $1,083 for deduction. So this deduction grows by leaps and bounds.
I was
the
going
more
to say,
heads.
that's double your take there.
And then it doesn't grow so much.
Oh, then not so much.
A family of three gets $1,249 for a deduction, so I guess more macaroni and cheese.
Right.
And then a family of four gets $1,509 as a deduction. So granted, that's a lot more than the single person of $570, but the increment doesn't jump up so much as each person gets added to the family size.
Now why is that?
Because that's what Congress determined.
I was going to say what they allotted, yeah.
These are taken from a handbook of the Internal Revenue Service that created this system, and it was incorporated into the bankruptcy law. And it's for when taxpayers owe the government money, the IRS uses this type of formula to determine what's reasonable for the taxpayer to pay back to avoid Internal Revenue Service from doing nasty things like seizing their income and taking things away.
Okay.
So it's already kind of been there, and we don't really understand exactly IRS's thinking on things, but it is what it is.
It's the law that we have to follow.
That's what we go with.
Sure.
Yeah. So we've kind of covered what's happening in the home. Let's talk about when we have to do some traveling, maybe for work or just life.
The last big deduction in the formula is transportation allowance, and this isn't such a great deduction, at least the amounts they give. So if you have one car and each person up to two cars can have, well, that wasn't phrased right. Each person can claim one car up to two maximum.
Okay.
So a husband and wife can claim two vehicles.
Okay.
A single person claims one.
Okay.
So you get an operating cost. In theory, the operating cost is gasoline, maintenance on your car, and car insurance. but the deduction really doesn't, I think it's not commensurate with the real costs. They give you $191 for a car.
For everything?
Wow.
For everything. That's not so great.
No.
And so up to 2 cars, if there's a husband and wife in the family, you get to double that, so you're at $382.
Is that a per month cost?
Yes, that's
Okay.
that's a monthly cost,
Yeah.
but when you're factoring in the insurance
Yep.
and
Right.
the gasoline and registration and car repairs,
Yeah.
it's not so good.
Yeah,
At least
hopefully you're
in
driving
my
a nice vehicle that's not going to break down on you.
Hopefully.
Hopefully.
Now, there's a second deduction that a person can get on the formula for these same vehicles if a loan is connected to the vehicle, either a loan that was used to acquire the vehicle in the first place, the common loan. You go down to one of the dealerships and you have to get a loan through Ford Motor or Wells Fargo.
Yep.
And so if you have one of those, they give you something called an ownership deduction. Again, this is supposed to be commensurate with the fact you've got a payment of some kind and what's to be fair. So it's $471 for a deduction. And it gets a little bit more twisted and complicated than just that. Technically speaking, they take the remaining months you have on your loan agreement and you plug that into this formula with ownership cost, and you multiply that times 6. You divide it by 60, and it's going to usually be lower than what your actual amount is.
Right.
So, but 471 is the amount they give you. Now, if you've got a $100 a month car payment, you still get the 471.
Oh, okay.
So that is generally fair. And then if you have 2 vehicles, you get to double that up to $942. So in that way, it's pretty good. And now if you don't have a payment and you have an older type car, which is like 5 years old, and most people don't have a vehicle paid off if it's under 5 years old. So
Correct.
you get another $200 deduction on the operating cost
Oh, okay.
if it's not got a loan attached, but it's not nearly the deduction if you got that 471.
Right. Helps a little bit, but
So
not always enough.
they're pretty big deductions to have a loan tied to it. And so in the bankruptcy planning, if we're getting close, we can take people's vehicles that don't have loans and create loans that hadn't existed before.
Are you serious?
And we make real loans. I mean, we're above board. Somebody will in fact loan them some money on the vehicle, and a lien will be put on the vehicle just like it was Wells Fargo. And it's legit, even though it's been contrived, and the money has to change hands and you get the deduction. And some people put up their cars after they're paid for as collateral. They need money, and they
True.
go to finance companies or places like Wells Fargo and say, I need a loan, or credit unions are good examples, and they have to give their car as collateral. So we do this just with family members or friends that'll do the same thing, and they use the money for something and you get the deductions.
So you can get that higher deduction.
Right, so it takes a little bit of imagination sometimes to
Well,
get
that's why
these
people need to be
things.
calling you, because you know all the ins and outs. All right, so let's talk about another big one, and that's healthcare expense.
Healthcare, they give you an automatic amount for healthcare per person in the household, whether you actually spend it or not. And so that's $54 per person if you're under age 65. If you're over the age of 65, it goes up to $130. These figures recently changed. They were higher for many, many years, and then they dropped. And I don't know how many times the people that do this have gone to the doctor, but I was astounded.
I was going to say, that hasn't gone down. The price of that
it
hasn't gone down.
It was 144 for somebody over age 65, and now it's 130. And
Wow.
yeah, so that was
And with with Affordable Care Act being passed, a lot of people are seeing their health costs actually increase in some respect, depending on how your age and your current level of health.
right. Although I suppose it was supposed to limit how much you had to pay out of pocket, because at least you had some insurance versus having no insurance. So
Correct.
your ultimate, it's better to maybe owe several thousand than owe 50,000 if you were hospitalized, I guess. So, but that's a big deduction, and you get more than that if you have chronic conditions or lots of
Okay.
prescriptions and things. And so if you have $200 or $300 or $400 a month between seeing doctors and taking medications, as long as you can back it up with proof, you get those deductions. So, and we do have people that are ill and have chronic conditions, or they don't have the best of insurance and or they have no insurance and they're paying out large amounts, especially senior citizens,
Right.
for these medications. And that will be a big help on the means test. Another important thing is for those that are religious in nature, they allow a deduction for religious contributions. And so these are going to be more of the standard type things. I don't know that they allow for someone that sends in their money to the televangelist, but for those that attend their church or synagogue or other religious organization and they give some type of offering on the day they go attend, typically these organizations will provide things for tax time so you can take a deduction on your tax returns for these items.
Okay.
Or you cut a check or you get receipts and you can prove these things. So you can deduct those off the means test, and that can be fairly significant. The law allows up to, I believe, 15% of a person's gross income, but you just can't find religions because you decided you want to get out of debt.
You have to prove it. You
have to have
can't
a
just say,
record of
oh yes, I've
contribution.
given so much back.
Now, what about people who might give cash in an offering plate? How?
It's a good idea to get a receipt.
Excuse me, Father.
When the basket
can I get
comes
a
back
receipt?
around, ask if there can be a receipt in there. I tell you what, folks, so many things to keep in mind to find out if you are at the level of filing Chapter 7, and we want to make sure you have all the information correct and in order. So you need to call Mike Jenkins at Jenkins Law Firm, and how can they get in touch with you?
You can reach me at 255-1855. We'll be happy to talk to you on the phone, or you can find me on the internet at www.iowa-bankruptcylaw.com, or you maybe even see one of my commercials after Bonanza.
Dun, 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 dun. If you've missed any part of the means test, make sure you check out weareiowa.com. We have all the segments up there, and you can really go step by step through with us to see if you do qualify. All right, folks, you're watching CW Iowa Live. We will be right back.